So let's bring in here Warren Hogan, independent economist and a consultant with the small business lender Judo Bank. Warren, I just want to start by talking about something I hear Australian politicians, government politicians say often, and that is, oh, well, this is all about inflation, and all that inflation has been imported into Australia. Now, the Prime Minister last week gave a speech at the Committee for Economic Development of Australia, CEDA. Have a little listen to this. We've got to grab there somewhere, I think.
Advanced economies around the world are dealing with the very difficult combination of high inflation and rising interest rates. Russia's illegal and immoral invasion of Ukraine continues to impact international energy markets and supply chains, and tight financial conditions overseas following recent bank collapses are adding to the climate of risk. Australia is not immune from any of this uncertainty.
Isn't it time we belled the cat and said that the inflation that Australia is now experiencing has nothing to do with Russia's invasion of Ukraine? It may have last year, but given the fact that oil price is down at $70 US a barrel, when it was $120 a barrel, that's not the cause of the inflation. The supply chain issues are broadly fixed. That's not the cause of the current inflation that we have got. This inflation we have got is homegrown.
It is, yep, totally. And the politicians, of course, want to try and blame someone else and also not have to act. It's all up to the RBA, it's overseas problems. But of course, this is all domestic services inflation now. And of course, as we continue through this year and into next year, wages. It's all about wages. And of course, the government's talking wages up, egging on the Fair Work Commission for these big wage rises. So look, I think that the story has been always about domestic inflation, that the pandemic shock, this international supply chain issues, that was always transitory. And it's about how strong this economy is and the domestic imbalances.
And so that means that Australia, having been relatively slow to understand and address inflation, now finds itself behind most other major economies, in particular the United States. And we can show that, can't we?
Oh, well, we're well behind. I mean, we are lagging a little bit in the cycle, but really that should have been a heads up for us to give us a chance to get ahead of it. But we haven't. And of course, this means we're going to have to keep hiking even though others have paused. This is the real US interest rate versus the real Australian interest rate. And
so just to explain that, that is actually the current cash rate of Australia versus the United States once you strip inflation out.
Yeah, exactly. It's just interest rate minus inflation. The Fed, there's no coincidence the Fed paused last week. Their real interest rate now is at zero. They can now sit back and have a look for a little while. Whereas the RBA, to be fair, they've got the real interest rate up towards -2 from -4 at one stage. But I think the governor his game plan is to get that real interest rate to zero. If inflation is good enough to come down to 4 by the end of this year and we get the cash rate up around 4.5, then we'll have a positive real interest rate. But it tells us that the RBA still has work to do, and that's exactly what the market's reacting to.
But it's only at that point in time that the economy really does start to slow down, to do the work of those interest rate rises. But if you've still got inflation way higher, if you've got the services economy raising prices, if you've got insurance premiums going up by 20%, if you've got heating prices in many cases going up by 50%, it's very difficult to get that inflation out anytime soon.
Well, that's the problem, and that's the real risk here that the market's starting to cotton on to, is that we're going to get all these price rises on 1 July, and we may not get that 4% inflation result for this current year, the current forecast for most economists, the RBA. And of course, that means we won't get the real interest rate to zero unless the RBA starts taking that cash rate above 5. So the market's really starting to sort of lose its patience. I think the RBA may be starting to lose its patience. And of course, we're really opening the door here to an interest rate here in Australia that's got to match what we're seeing in places like the United States, New Zealand.
But as most bank economists, and you have said for a long time, if you have that scenario play out, the inflation doesn't disappear, you've got to jam up the rates to actually try and get it, then the risk of Australia tipping into recession, shallow, deep, whatever it might be, is increased as a result.
I think we're not going to get out of this without a recession. It's just whether it's a mild, short-term technical recession, effectively a soft landing that's a little bumpier than a normal soft landing, or whether we have a genuine hard landing recession. The difference between the two is whether the RBA cash rate goes to 4.35 or 4.6, or whether it has to go to 5.5.
But at the moment, you've got full employment. You don't have banks with any real credit issues. That's a fundamental difference, which suggests that the recession, if it does occur, is more of a slowdown, not necessarily a crisis.
At this stage, the banks looks good. And of course, that's when a recession turns nasty, is when banks are so impaired that they can't extend credit to the economy. That's the early 90s recession. And of course, we're a long way from that at the moment.
We're a long way from that. That's fascinating to see. Anyway, Warren Hogan, always good to have in the program, and many thanks for your time today.
Thanks, Ross.